The only thing that's, I think, not priced into the markets is the political outcome. And
Mm,
I've been saying for a year, and probably said it to you in one of your interviews, that there is no outcome to this election that will be copacetic,
mm,
meaning normal, meaning stable. Okay.
right.
No outcome. I don't care which side wins. I won't take a side. Whichever side wins, the other side will not respond in the way that any other election has ever turned out. And is that priced into the markets? I don't think so.
All right. Welcome back to Capital Cosm, guys. Today we've got fan favorite Michael Oliver making his return to the show. Michael, thank you so much for coming back on.
Glad to be back on.
Pleasure to have you here. If you guys are enjoying this content, I'd like to remind you to hit that like and subscribe button. Smash that subscribe button, as tried as it may sound. It does go a long way. Michael, I'm not going to waste time mincing words, and let's just dive right in. What do you see out there by way of the economy in terms of broad strokes? Let's start off macro, and then we can kind of hone in on specific topics. But in terms of like a 30,000-foot view, what do you see going on out there?
We think the stock market is topping. A lot of the market topped in 2021, 2022, and has not exceeded that. Okay. But some of the market has because of, we have leadership symbols that are heavily weighted in S&P, NASDAQ 100 especially, that have driven near new highs by, 5, 6, 7, 8, 9, even 10% above the 2021 highs. So people think, well, it's ongoing. Well, we just had arguably a 15-year. Well, you go back to 2022, so a 13-year bull market. You go back in American history, you never had a bull market last that long. Okay. Of course, if you look at a money supply chart or Fed funds chart, how come? They filled the tank, okay? And they kept filling it. They kept filling it. So monetarily, it was a great monetary bubble. And a lot of the assets went into stock market. 2021, 2022, we saw the first sharp pullback. That indicated to us that we're in a topping process. We've since gone up and made the new high. Now, if you waited 2.5 years, you're actually ahead of the game by 5 or 10% where you were in 2021, 2022. In other words, you might have done as well in T-bills in that last 2 years. But we think we're still topping. And if you go back and look at prior tops in the market, really, 2007, the entire year was a topping process with a final stinger on the upside in October of 2007. Why? Fed cut rates in September, surprised everybody when they did. And everybody said, oh, it's party time again. No, it wasn't. That was the beginning of the end. And within 3 weeks of that first surprise rate cut, market topped and went to hell for the next 2 years, despite rate cuts all the way down. So anybody who's buying the market right now, because the Fed is clearly going to cut rates, they even said so. And so it's not a surprise this time. If you're buying the market for that, go back and look at 2000 top and the 2007 top. And you'll see that when they started cutting rates, if you just circle that on the chart, that's where you want to be short. It's an investor. Okay. So it's not a good idea. It's negative that they're cutting rates. There's something going on. Also, it means they're once again, going to turn the spigot on, monetary spigot, in various ways. Lower rates, greater money flow, maybe buying assets, all these various things that central banks do. And that, of course, helps degrade the value of the money unit, the dollar. I don't mean relative to other currencies, although that's occurring right now. I mean just in buying power. And it helps, ultimately, monetary metals. I'm not saying, by the exact moment, but, in general, that is what drives gold up, is the degradation of the money unit ongoing. So anyway, that's the context I see in the stock market. In fact, the action that we had a month ago when we had the sell-off in the S&P and the NASDAQ, and then the sharp rebound, which took the S&P back to its high, not quite through it, it probably will nip it out, and NASDAQ back up toward its high. That low that we made from our momentum vantage point was critical because we've defined a structure. You cannot see it on the price chart, but when you look at our quarterly momentum charts, pardon me for saying this, we have a pattern that is similar to 1987
I see.
on quarterly momentum. We have a structure built that if you go back to that same level on quarterly momentum next quarter, meaning 20 some odd trading days from now, I'm going to blow that structure. Now, for example, let's look at NASDAQ 100. Its low recently was where we thought it might be, 17,500. That's the three-quarter moving average itself. It stopped right at it and rebounded now to 19.5 level, not back to the highs. If you go to about 18,600 during any time during the next quarter, I'm going to blow that momentum structure. Meaning momentum says you just blew a massive floor, even if you can't see it on the price chart. And at that point, I think you could get some horrendous downside. Between now and then, I expect to see some sort of another rebound between now and, let's say, early September, where the S&P tries to finally go up and nip out that high, which it hasn't done. NASDAQ gropes around. But if you start to decay later in September on those indices, like you get that NASDAQ about 4% below where it is right now, I'm going to be in a position when I open October to break that structure. I hope you understood that. But we see things from a different point of view than price. We see momentum structures much like you would look at a price chart. And we see a structure on the momentum chart that says, my God, you better not go back down to that level again.
For those who may not know, what is the what is the caveat between price versus momentum? You're big on the momentum side of things. What edge does momentum give you over price?
Usually, almost always, I say this, momentum will top out. In other words, if you look at a price chart, let's say a monthly price chart of the S&P, go back years, and you look at a monthly bar chart of the S&P plotted against its three-quarter moving average, for example, or its three-year average, long-term metrics, you'll get a different picture. It won't look like the price chart. The price chart will look like this, and momentum will look like it's built at a floor. And if you ever break that structure, just like if you had a price chart floor that you could see on a price chart where a stock goes down to a given level, same level, same level. And when you break it, therefore it's negative, right? Okay. Well, you'll see that develop on momentum, possibly without any such resemblance of that on the price chart. So price doesn't warn you. In fact, if you go back and look at 1987 or 1929 or any major drop in the market, and look at the price chart, you can hardly tell why it collapsed at a certain point. In other words, you look at it and you try to draw lines, you don't understand why did it collapse. Well, when you look at momentum, it smacks you in the face. It says you've done something horrible, structurally speaking. Bridge over the River Kwai has been blown up, okay? We've set such a structure now on quarterly momentum of most major indices, especially the NASDAQ 100, which arguably is the leader index. S&P went up 7-8-fold since 2009. NASDAQ went up twice that much in terms of relative gain. So it's far bigger bubble than is the S&P 500. Why? The front-end loaded tech stocks primarily. Anyway, so I think we're facing that confrontation over the next month or two, where that last rally we just had, you better not go back even about halfway to the low we made a month ago, because you'll start blowing these structures on momentum, in which case momentum says, get out of the way. That will mean real world things,
Right. Now you made parallels to 1987. How steep do you see this correction being, should it occur?
87 was different than, for example, 29 at a similar situation, which sustained to a bear trend through 1932. 87 was the end of a decline, and it was a 35% collapse in 2 weeks. That's what a crash is, 30% plus in a matter of a few weeks. This time, it's the onset of a bear trend. It's not the end of something. In 87, what you did is when you broke your structure on quarterly, it had to puke. And you looked at annual momentum and said, hey, you're down to support. And it held and turned up again. This time it's different. But the real world implications of that will impact data points. The things that, well, we already know they've been softening. The job market's been softening drastically. They revised the number. Remember, it went back a year and they revised it They were off, so far off, it was meaningless what they'd said before. Job market is not in good shape. Fed knows that. All of a sudden, you're going to get hit with other things, other data points. And usually they follow the stock market. They don't lead the stock market down. So if you go back and look for data point arguments to be bearish in 2000, 2001, or 2007, you don't find them. It wasn't till later that suddenly the data points gave the sucking sound that the market did. So I think the breakage in the stock market will be the onset of negative data points, which will what? Will then encourage the Fed to even be more aggressive than merely cutting. I wouldn't be surprised by 0.5% in a couple of weeks, because already the data points are pretty bad. Market's certainly counting in at least 25, so there's no issue about that. But that changes a lot of things. A lot of tectonic plates, not just the stock market, are moving, and they're not moving in the same direction. We see the monetary metals, for example, as merging to the upside after their 3 years of boring gold action and downtrending silver and minor action. They've now broken out to the upside back in March by our metrics. Back then, silver was just above 25, gold was crossing through 2,000, and GDX, for example, the mining ETF, very popular, was crossing through 31.5. Right now it's trading around 39. So we're well above those levels, but we've had a pause. And if we start to see the stock market roll over again and the Fed push the panic button, that simply injects more fuel into the tank of monetary metals.
Really? And so you think gold and silver will actually go in contrast to the market?
Yeah. Well, if you go back to 2001, 2002, especially starting in 2001, gold was coming up off of a low and started a bull trend. Stock market was peaking. Stock market went down through 2002 while gold rose and continued to rise through 2011, of course. Also, the T-bond market, U.S. government bonds, not municipal bonds or high-yield corporate, but T-bonds, they went up with gold as well, starting in 2001, 2002, while the stock market went down. Go back to 2007 again, the top in October. S&P then was 1575. Well, it got ultimately down in the 600s, okay? But in that 2-year decline, T-bonds and gold went up. Now, the question, of course, comes to investors, what if there's a crash event? Then, like there was that month or so in October of 2008, when a year off its high, the stock market finally did produce what you could call a crash event, where it dropped like 30% in a couple of weeks, okay? But way off its high already. It was already well into a bear market. And gold had been going up, but gold suddenly said, oh, okay, I'm going to join you. And for a month or so, gold did join the stock market and then went rapidly back to its highs, by the way, by early 2009, excuse me. Stock market went on down through 2009. But right now, we're getting the same type of indication from T-bonds, for example. So not only do the stocks look vulnerable to break, but quarterly momentum of T-bonds has already broken out to the upside, indicating what? That asset category is again being favored by asset managers as a, quote, place to be as an alternative. The 60-40 notion, orthodoxy of 60% stocks, 40% bonds. Well, that was a disaster policy in 2022. They both went down big. So it was no good. This time around, it's different. Bonds look like they're going up. I'm talking U.S. government T-bonds only, not muni bonds, not high-yield corporate debt. They look vulnerable. But there's a shift recently into T-bonds. It's very noticeable. And of course, since March, a shift into gold again, where it's come to life. Instead of 2,000 area, we're 2,500 area. So the issue now is the breakage of the stock market, further fueling that asset class shift. And I think that's what you'll see. The more the stock market weakens, more asset managers will say, too high risk, low reward. I'm going to go to something lower risk, higher reward. Monetary metals and bonds.
Yeah. So is there the possibility that they can foreseeably kick this can down the road even longer? I mean, let's say, is there a way that the topping Doesn't occur until much later.
Technically, I don't think so. I'm speaking technically now. Long-term technicals.
Mm-hmm.
They already look fully. In fact, the 2022 break broke the integrity of an annual momentum trend that had been underway. Again, I'm talking momentum now, in the NASDAQ and the S&P since 2009. Very aged uptrend broke in 2022. And even the recent recovery in price, which just made nominal new highs in price. Momentum looks like, if you saw the momentum chart, you would chuckle, say, Jesus, no, it doesn't even look like the price chart. It looks like a lame bounce. Okay. What we're looking at now is something less than annual momentum because it's already in what we call fractured mode. It's already saying you have my blessing to go down. Okay. We're looking at quarterly momentum. It's also long-term, but less long-term. And it's saying, I've set a structure. If you break it, I'm going to rejoin the annual. So these two long-term metrics are going to do this at the same time. And I think that will spark not only the fundamental changes that we're talking about, the Fed policy, for example, but the asset class shift preferences. And already we're seeing it in some major non-gold bug type money managers who have moved into gold mining stocks, including, Druckenmiller back in February, mid-February, bought heavily, dumped a bunch of tech stocks, big names, and he hasn't missed much, okay? And bought Newmont Mining, biggest gold miner in the world. It was then about $32. It's trading right now $53. Was it 6 months later? He's up like 60%. Why? What's going on there? He wasn't the only one. And I think there's an awareness on the part of asset managers that, hey, this is an undervalued asset category. I need to hedge my bets and move somewhat into this because it's related to gold and it's also undervalued, the miners, though. And I think you're seeing that. And I also think the recent breakout in T-bonds is also indicative of some asset flow out of the high-risk stock area into the perceived lower-risk T-bond area, at least lower risk for a while. And I think that those shifts that are occurring in these tectonic plates is indicative of the larger picture.
Right. What about silver, though? Silver seems to be, can't seem to get past that pesky $30 range. It did break above it for a bit.
Yeah, it got well above it and got below it and got above it and got below it. And, I agree. It is we call it the wild dog. Okay. Meaning it's on a leash. And the leash is controlled by the trend of gold. But it swings ahead of gold, it swings behind gold, and it does so wildly. So gold may move 1 or 2%, silver move 5 or 6%, up or down. Lately, we've had gold stall up above 2,500 this month, which is, by the way, new high, all-time high close. And you closed about $40 off the high of the entire move today, settlement price. Silver's, 29 area. Heck, its high recently was over 32, and its recent low was 26.50. So it's right sort of smack in the middle of the range of the last 4 or 5 months, whereas gold's at the high of the range. So that confuses a lot of people, and it confuses us a little bit. But ultimately, silver will oscillate wildly, both ahead of gold and behind gold. And we think you get silver back over 30 again. Again, this week we basically got up, nudged the 30 level. Get back over 30 again, it's going to re-engage and go back to that 32 level, which it's been at twice. It was there in May, I think, and again, it dropped and it came back up there in early July or in June to 32, and then had to plunge down under 27. You get back over 30 again, I think you're going to challenge that 32 level high for a third time, and this time you won't stop. The miners are very interesting. They've outperformed gold. Yes, they are below their 2020 price high, which in GDX's case was above $45. Right now we're 38, 39. We recently got up close to 40. So it's still below the 2020 high, whereas gold's above that high. But actually, if you measure the miners since the low of this year, which was a pullback low in February on gold, silver, and the miners are well off that low, more so than gold. So since the February low, the miners have been outperforming gold again. And I think that's going to continue. And I think it's partly because major asset managers are perceiving that they want to participate in this lower risk monetary metals sector.
Are you in the market for gold and silver? Then if so, please consider Miles Franklin. They are my gold and silver dealer of choice. So not only do they have super competitive prices that you're going to have a really hard time finding elsewhere, but then they also have top-notch customer support. I know Andy Schechtman, the owner of Miles Franklin, top-notch guy. I wouldn't be recommending them to you if I didn't have faith in their product. But what you really want to do, however, you want to email them at info@milesfranklin.com, and you want to say that Capital Cosm sent me in the description line, because when you do that, you can get access to their special pricing sheet. You want to get that special pricing sheet because you're going to get special prices that you won't find on the website itself. So email them at info@milesfranklin.com. Tell them that Capital Cosm sent you, and you won't be heckled with spam emails, etc. There's no commitment necessary. I promise you that. And with that said, I will let you get back to the video. Yeah, we've talked about rate cuts. They've got this 25 basis point rate cut, supposedly in the books, with 100% chance of that occurring, according to the Fed CME watch tool. I mean, do you think that they'll eventually bring things down back to 0%?
Most people think that's impossible. I'm sure Powell would say it's impossible. But you break this stock market. And again, let's assume that MSA is right, that it's the biggest bubble in U.S. stock market history. 29 doesn't compare. Measure from the 23 low to the 29 high, 5-6 years, double, tripled. .com bubble. S&P was a triple. Okay. 2007 peak was a mere double from the 2002 low, again, about 5 years. This one's double to triple time and triple or more the gains that we saw back then. And you say, well, maybe because the economy is so good. Well, no, look at Fed funds rate, free money for 10 of the last 15 years. Free money, okay? People invested, okay? And then two, look at the monetary growth. The monetary growth the last 10 years is a lot more than it's been in any other 10-year period. So again, it's the degradation of the money unit. And therefore, when you measure by the money unit, prices go up if the money unit itself is decaying in value. That's why when I was a kid, a loaf of bread was under 20 cents. Now, what is it now? Okay. Do we have a wheat drought? No. You have a degraded money unit. Every 10 years, it almost doubles in quantity. And now once they panic again, it'll increase more in quantity, therefore degradation. And now that you think, well, why doesn't that maybe put resurgence into the stock market again? It's our experience that when a bubble breaks, even those lesser bubbles, like 29 or mid-1970s, 2001, 2007, when those bubbles broke and the Fed came in to rescue, with the same thing that helped create the bubble in the first place, it doesn't work the next time. Once the bubble takes over and it implodes, it's on its own. And the Fed can't stop that reality. They've never been able to. All they do is start printing and printing, and ultimately that may create the next bubble. This time, though, we have the biggest bubble ever, and therefore the consequences of its breakage could be in the real world far worse than, for example, 2008 and 9. Given the nature of the errors compounded over that period of time.
Yeah, I mean, we don't only have the biggest bubble of all time. We've also got the steepest and longest yield curve inversion of all time as well.
Yeah.
What does that mean? What significance does that have?
I'm not an expert on that. I know a lot of people have focused on that it's been occurring, and therefore you're going to have a recession. In fact, you're probably in a recession, unless you trust government data points. But again, we're focused on our knowledge of market history, technical analysis of the long-term momentum dynamics of the market. And we argue that no, if you believe that the recent new high in the stock market, again, marginal versus 2.5 years ago, is sustainable, fine. You believe that all you want, but you better not go back halfway to the low we just made. And if you do, consider getting out. Because at that point, we're going to blow a floor that's 2 years wide on momentum. And when you break it, if you saw the momentum quarterly chart, you would say, my God, I don't want to break that line. And getting halfway back to the low we just saw will do it. And that's like 4% below where NASDAQ is right now. Also, if you're a candlestick chartist, price chart. You know what candlesticks are, the Japanese candlesticks.
Yep.
They reveal a lot more than does a simple bar chart. And if you look at it, punch up on your quote screen, those who are watching this, a candlestick of monthly action of the S&P and NASDAQ 100, and even a lot of the main tech, you can look at NVIDIA, it's doing the same thing, and punch up a candlestick version of the monthly chart. And you'll see what's called a hanging man. What a hanging man is a big, wide range for the month. And we certainly have a wide range from a deep low to an upper high, where you close out the month so that the candle body is pretty small in relation to where you actually opened the month. So you open the month, you collapse, came back up, and you got a higher close than where you opened the month. But it's a little teeny candle body, and it looks like a hammer. Okay. If at a low, it's called a hammer, and it's bullish if you've had a big drop. Instead, if you've had a big advance, it's called a hanging man. We've not seen a candle like that in years in the S&P, in the NASDAQ, in so many places. So even the price chart from a Japanese candle point of view is saying, pause and consider. Things are not what you think they are. Even though price rebounded from that low, it is not a good candle. It's usually a terminal one. The test is, from the candlestick point of view, which has been around for hundreds of years, by the way, that methodology. If you drop next month below the lower end of the candle this month and close out next month below that, which is to say drop very little, you'll do that, then that validates it as being a hanging man, a topping candle. So even from a Japanese candlestick point of view, you've got something this month that says, wake up.
Yeah, so we've talked about this, this stock market crash that we could see because of this bubble. You did mention the contrast in precious metals, though. My question to you is, however, is that gold and silver stocks are still stocks. So yeah, how will they kind of hold up once the pricking of the bubble occurs?
Well, first off, you got to realize that they're vastly undervalued. You run a spread chart, meaning, like, say, XAU index divided into the price of an ounce of gold, and run the chart, go back 50 years, as far as you can. Back to the 80s is when that index began. And it's gold and silver miners, Philadelphia Gold and Silver Miner Index. And you'll see that we're at such low levels in relative performance that we're so far below the levels we were early in the 2000s, 2006, 7, 8, and so forth, that it's just off the page cheap in relation to gold. And you do the same thing with S&P, measured gold miners versus it. It's off the page in the dirt low. You know, you got to buy it almost. You look at the chart and say, God, there's no risk anymore. Okay. It's actually starting to turn up, the spread is, in its relationship to gold and its relationship to the S&P. And if you break the S&P any, and that miner shares don't break down, instead they stay firm because of an asset class shift, then that spread's going to break out again, meaning, looking at it from a relative performance point of view, buy miners, sell the stock market. Buy miners instead of buying gold. And I think we're in that position right now. And I think a lot of large asset managers realize that they are vastly undervalued. And that's why, for example, Newmont Mining went from $30, $31, $32, and now it's $53 in a matter of 6 months. What the hell happened? Stock market didn't go up that much, but the gold miners did. And also, when we've had flinching in the gold sector, the mining stocks in general, when you look at some of these big blue chips like Agnico Eagle Mining, all-time highs right now. Back to its 2011 high, it's 2000, all highs of history. It's back there. And look at Newmont. It doesn't flinch. You get a bad day in GDX and you look at Newmont, and it's unchanged. There's some kind of demand going on there. And I think it's with large asset managers making that asset shift reallocation. And I think now, if you get a crash event, I'll admit, you have to be open to the possibility, if the gold and the mining sector are vulnerable for such, meaning, let's say they're overbought, as was the case in the 2008 break in gold. Gold had a massive move from 2000 to early 2008. Well, during some of that time, a year and a half of that, the stock market had been going down big. Okay. There was a point where gold did participate with the crash event in October of 2008 in the stock market. But at that point in time, gold was vulnerable technically. Which said, I'm overbought. I need to correct too. We don't have that situation right now.
What about the rest? What about the rest of the commodities? Do you see the resumption of this commodity super cycle as well? Okay.
We got bullish in October of 2020. Now the Bloomberg Commodity Index at that point had traded down under 60. Now the price only here now. 2008 high was 237. The high in 2011 when gold peaked, it was like 170, I think, on the Bloomberg. Dropped to under 60 in 2020. It was October of 2020, it turned up. While gold had doubled in price from 2015 low through the 2020 high, Bloomberg had continued down. So it wasn't correlated to gold. But then it exploded from late 2020 up to early 2022 when the war started, Ukraine-Russia thing. A month later, commodities peaked. They didn't go up because of the war. They peaked right after the war. Okay, so the argument used that, oh, they went up because of the war. No, they didn't. They peaked right after. Even oil peaked like a month after the war started. And then they've corrected. Well, they've corrected about 50% from that high, 140 on the Bloomberg then, pulled back down to around 100 either side of for the last year and a half. Look at a Bloomberg chart. It's like asleep. Just it's anemic, but it's really not going down. Right now we're trading about 97. You could gone back a year, bought it at the same price. So it's really gone dead. And we think it's ready to resurge again. This time it will be in synchronization with gold. When's the last time that happened? Late 1970s, stagflation era. Gold turned up from a bear low, a corrective low in mid-2000, 1976. Really started going again in 77, 78. Commodities joined in. And so you had stocks doing nothing. They were deadville for 10 years, and commodities and gold booming. Now, admittedly, less so than gold, but still quite strong. I think we're in the same position again where the Bloomberg is about ready to turn back up again in a credible way. And it's not just going to be primarily energy this time. They led the last move. That 2021, 22 move was primarily led by oil, but everything went up. This time, I think it'll be probably more food-oriented. I tend to think the grains might actually outperform oil on a percentage basis. But anyway, they look ripe to go up. If the stock market goes down, it could help them. Why? Because again, if the Fed puts money in the system, asset managers do what with it? They commit it to something. They look at what's low risk, what's higher with better reward, what's higher risk, less reward. And once they make that shift, they tend to commit to it for a while. And I think you're having a perception out there that commodities are still cheap. You know, they say, oh, commodities are off the page. They're trading around 100. Heck, it was 237 in 2008, 170 in 2011. So we're still cheap on the Bloomberg. It's not like commodity prices are high. And so if there's an asset class, there's money flow again, asset managers will allocate it. Well, in 2009, the stock market was definitely cheap. Okay, 600 something on the S&P. It had been 1,500, so it was cheap. They committed money to it. Fine. This time it's the opposite situation. And I think the stock market breakage will actually help commodities because it will fuel, again, monetary injections, which will go somewhere. I think they're going to go into commodities basically and into commodity-related stocks, oil stocks, grain-related, et cetera, fertilizer, so forth. So that will be a place to be in the stock market.
So you're seeing the food side of the commodity complex taking the lion's share of the growth, or is it more so the precious metals?
The precious metals, they include gold and silver in the Bloomberg. Okay, they're included. Not platinum. It's not included, by the way. And it's a precious metal, not a monetary metal. But when I look at the other commodities, copper, base metals, energy, natural gas, oil, etc., while they led on a percent basis the gains from late 2020 to 2022, though everything did go up big. Okay, grains too. I think this time around, grains look technically poised for a greater percentage upside. I don't mean hands down, it's the only place to be, but they all look poised to go together. So the Bloomberg, when it moves, generally you can expect the grains, copper, oil to all participate, whether it's up or down. And I think it's now poised to come up out of this hole, this 50% pullback in Deadville for the last year and a half, and go back up again. And I think probably one of the factors is going to be the shift in asset allocations, and again, the injection of capital into the system, thanks to the Fed.
Yeah, so will this finally be the time when retail begins buying up gold and silver? And like, you look at the recent rise in gold, and it doesn't appear to be driven by retail. You look at things like so it seems like it's a central bank driven rally.
Yeah.
And so
it's certainly not our central bank. Yeah. Okay. No, I agree. And that is yet to happen. There's American, particularly Western interest in buying gold, especially American interest in buying gold. It's just not there. They still believe in the belief structure of the fiat money and all that stuff. And I think once that gets fractured and they see gold continue on up and they see the other assets hurt them, whereas you've got you're in your portfolio, your retirement account, all of a sudden you're not smiling anymore and you're looking around for what's been smiling. And you say, well, I'm going to go with what's going up. And if gold is still going up, which it's so far been doing, you will want to join what's going up, regardless of whether you have an ideological belief in it or not. It's a simple matter of what's working, what's not working. And that drives a lot of asset managers as well. Not necessarily deep intellectual. It's just what's going up.
Yeah, I mean, you see this when you chart out like the the gold to S&P ratio, the commodity index, the CRB to the S&P ratio. I mean, these things are you just see it on the charts when you chart it out. They're incredibly cheap. Do you see us retracing all the way back up to the highs that we've seen in those charts, or
I'm not that illusional on the spreads. We've done studies in our report showing the XAU versus gold and XAU versus the S&P. And while I think they could burst big time on the upside in terms of relative performance and a percentage gain in the mining stocks versus the S&P, for example, I don't think they'll go back to the old highs that we saw in 2006 and 7, but it doesn't matter even if you go halfway back.
Right.
And there's some spread reasons that we explain in our charts why maybe you only go halfway back. But even that is monstrous in terms of percentage gain that you would have owning miners, not owning the stock market, or owning miners in preference to gold. The relative performance could be enormous, just going back halfway to those levels. And there's actually some chart resistance there on the spreads. So while we're positive, no, I don't think you necessarily go back to those levels, but still, it's definitely worth paying attention to. Because it could be.
Yeah, here's another tailwind for you. So if you chart out the S&P versus the world stock market, the S&P has been outperforming the world stock market for decades, right?
It's a bubble among bubbles, even versus other stocks. Yeah.
Right. So our stock market here in America is kind of a safety haven for foreign capital, especially as their stock markets in their currencies value and so forth. So I just had this thought actually. So could it be that there will come a time where they begin diverting their capital away from the American stock market and then into precious metals as opposed to that?
Or just out of the stock market, because remember, they buy it in dollars. Okay. So now Americans don't care about that. They just see the stock price. And I think that is good. You bought it at $10, it's now 20, 10 years later, you think you doubled your money. No, you didn't. You break even. Degradation of the money unit. Okay. You really break even in real terms. Okay. But when you're a foreign investor in the US market, and they've been pouring in for the last few years, we know that. And it's definitely, there's no comparison. Europe doesn't even look like us. China doesn't look like us. There's no bubble over there, hardly, compared to us. Watch the dollar index. It's been one of those tectonic plates that for the last year and a half, when you collapsed from the high in 2022 and collapsed down into early 2023, you went from 115 down to close to 100. And then the dollar index went into this coiling sideways up-down action since then for a year and a half. Nothing going on, about 5 or 6% range. And even if you chop off a few of the peaks and lows, it was like a 4% range. So it's total deadville in that major asset category. The recent drop below 104.40 turned us negative on the dollar index. We've now dropped down under 101. Now we know that everybody's looking at the 100 level because it was a low back then. If you take it out, they get into the price chart and say, oh gosh, I'm spooked. A long-term momentum already says be spooked. You broke a lot of stuff coming through that 104.40. And it says that the recent drop we've had in a couple months down to 100.50, 4% drop, which for the dollar is a big deal lately. Okay. You get a little rebound now, maybe get a little more because it's sort of oversold in the short term. But if that dollar index starts to break down and you're a foreign investor in the U.S. market, it's not just the price of the U.S. market that concerns you. It's the loss in the underlying currency unit when you convert back to euros or something. Mm-hmm. So if the dollar drops 5 or 10%, the stock market went sideways, you lost 10%. American didn't.
It's a double whammy, yeah.
Okay, yeah. So watch the dollar index in that regard, because that could spark an evacuation from the U.S. stock market bubble. Plus, a breakage in the stock market itself would help do that.
It becomes a feedback loop.
A break in the dollar, further drop, would get their attention and possibly cause a massive foreign evacuation from the market back to whatever. Yeah, maybe gold, but it doesn't matter. The point is evacuation from what they thought was an ongoing bubble and isn't.
Yeah, it kind of becomes, kind of like a feedback loop because, I mean, like we alluded to before, a large chunk of the American stock market is foreign capital that's just like seeking the safe haven. So, like,
I don't know what percent it is, but I know it's large, especially last few years. Yeah.
So that's
got to be a factor. Yeah.
Yeah. So not only do we see the the initial crash event happen, but then on top of that, you'll start to elicit foreign capital to sell their American stocks out as well. So it'll just be another stage of the collapse.
Yeah.
Interesting. I think we've covered a pretty wide gambit of things here, Michael. Anything else you want to talk about that we didn't get a chance to?
No, the only thing that's, I think, not priced into the markets is the political outcome. And I've been saying for a year, and probably said it to you in one of your interviews, that there is no outcome to this election that will be copacetic, meaning normal, meaning stable. Okay, right. No outcome. I don't care which side wins. I won't take a side. Whichever side wins, the other side will not respond in the way that any other election has ever turned out. And is that priced into the markets? I don't think so.
Yeah, and the going off the betting markets, because I like to look at the betting markets as opposed to the polls, because all of these polls are consolidated within the betting markets. Right now, it seems like it's a toss-up, 50-50. So.
Oh, is it really? Okay, fine. Yeah. But anyway, it's regardless. I'm arguing this, and I don't know what I mean by uncopacetic.
Yeah,
I'm not going to specify, but it won't be normal, and it won't be overnight. And so, notions of stability, all the dishes on the table will get thrown off. I don't care who wins.
Yeah, the other side, someone's going to flip the tables for sure.
Yeah. So sit back and watch and be ready for it, because I don't think that's priced in whatsoever in the stock market.
How would you price it in, though?
I don't know, except to say that it's a factor that's not priced in, and therefore it's one of those variables that once it gets priced in, and it wouldn't shock me it gets priced in ahead of the election. You get like into October and get to our quarterly numbers on NASDAQ, for example, I told you about, 4 or 5% below where you are now, you blow that structure. That when that happens, probably maybe then you start to get some other factors that are suddenly, oh my God, I didn't think about that. You know what I mean?
Yeah.
And now I understand, and I think maybe as you get closer and closer, people will realize, regardless if it becomes clear who's going to win, maybe it becomes clear before the election that Trump's going to win or whatever. That's not the issue. The issue is, have we priced in the outcome?
Yeah.
And certainty.
And look, if you're a hostile actor against the United States, you're going to see this, and you might even see it as an opportunity to do something kinetic.
Yeah, but it could be hostile even domestically. Okay.
Right.
And I don't want to define hostile. The University of Virginia did a poll back in October last year, which we published in December of last year. And they interviewed likely Biden voters, likely Trump voters. And the outcome in terms of questions like, would you resort to violence if the other side win? It was unbelievable high percent, like 20, 30%. Do you think democracy would win if it would end if the other side wins? The high level percent. In other words, the this is a year ago now. Okay, the antagonism under the surface is like never before. And again, there's a neutral body doing a poll, University of Virginia Department of Politics, and it's not only that makes me think this, but I can sort of philosophically see that this time it's different. Again, is that priced in? Think about it.
Yeah, definitely something to chew on. Michael, where can people find you?
OliverMSA.com. MSA for Momentum Structural Analysis. Take your time, explore the site. We get a lot of things to read and see, understand our unorthodox methodology. And anyway, consider what we do.
Yeah, we'll have the link to that down below in the description box.
Thank you.
Guys, be sure to check it out. Michael, thank you so much for coming on. It's been a great pleasure having you on. And if you enjoyed this talk with Michael, type "Go Michael Go" in the comment section. Leave us a like. If you disagreed with anything, that's perfectly fine too. Let me know why in the comment section down below. I do read the comments. So, lately they've been getting a little too much for me to handle. As the channel grows, I just don't have time to reply to every single comment, but I do read the comments, guys. So be sure to drop a comment. Let me know what you think. Subscribe to the channel if you haven't already. It does help and it does go a long way. And with all that said, I'll catch you in the next episode. Bye, y'all.